Making entries into the ledger accounts. You have already been introduced to the dual effect principle. To introduce ledger accounts, we will use the bank account as a starting point. An assumption made at this stage is that money is paid out and received in immediately. In reality, items may be purchased and sold on credit. Checks may not be banked straight away, and so forth. In accounting terminology, the use of the word cash and bank are interchangeable. Thus, the bank account is often called a cash book. The cash book provides an easy way of monitoring how much money is coming in and being paid out. Cash books are regularly reconciled to bank statements as a method of checking accuracy. Remember, all payments received into the bank account is a debit entry, as it is increasing our cash asset. All payments made from the bank account is a credit entry, as it is decreasing our cash asset. The rules to remember about cash transactions are: a cash payment is a credit entry in the bank account, as the asset of cash decreases when paid out. Therefore, a cash payment entry needs a matching debit entry. A cash receipt, on the other hand, is a debit entry in the bank account, as the asset of cash increases when payment is received. Therefore, a cash receipt entry needs a matching credit entry. Let's have a look at a simple example of a bank account for Ruth's Flower Shop. Ruth's Flower Shop has the following transactions within the first week of trading. For this illustration, all payments and receipts were cash transactions. By this I mean none of their initial transactions are credit sales or purchases. To start the business, Ruth invests $10,000 of her own money into the business on the 1st of January. Remember, all payments received into the bank account is a debit entry, as it is increasing our cash asset. The bank account will therefore be debited with $10,000. The date of the transaction is entered into the date column. A brief description of the transaction is entered into the details column, and the total banked is entered into the value column. The dual effect principle states that for every debit entry, there must be an equal but opposite credit entry. A credit entry of $10,000 is made in the capital account. This is because of the separate entity principle, which states that the business and its owner or owners are separate identifiable parties, meaning the business owes Ruth the $10,000 capital she has invested, making the capital investment a liability of the business and hence a credit entry. In order to run Ruth's Flower Shop, Ruth will need to buy stock. So on the 2nd of January, she purchases various flowers from the flower market, in total costing $1,000. Items purchased for the purpose of sale in the ordinary course of business are called purchases and are recorded in the purchase account. Take note here, purchases of equipment or supplies are not recorded in the purchases account. Also take note that the flowers bought by Ruth for resale in her flower shop are a good example of revenue expenditure. Revenue expenditure is expenditure on day-to-day items for the running of a business. The bank account would now look as follows. All payments made from the bank account is a credit entry, as it decreases our cash asset. The bank account is therefore credited with $1,000. The date of the transaction is entered in the date column. A brief description of the transaction is entered into the details column, and the total paid out is entered into the value column. The opposite side of this transaction would be a debit entry of $1,000 in the purchases account. On the 3rd of January, Ruth buys a work van costing $2,500 in order to make her flower deliveries. Ruth's flower van is an example of a non-current asset, also known as a fixed asset. Fixed assets are assets kept long-term in a business. For example, equipment, premises, and motor vehicles. The bank account would now look as follows. 2,500 will be credited from the bank account as the asset of cash has decreased. An opposite debit entry of 2,500 will be made into the van account, as the van is now an asset of the business. The purchase of the van is not posted to the purchases account, as the van was not purchased for resale in the ordinary course of business. Equipment, which is kept in the business for a long time and used in the running of the business, is called an asset. Other assets of a business could be premises, fixtures and fittings, motor vehicles, and computers. All asset accounts will have a debit balance. With all business expenses, proof of purchase must be attained. Ruth would need to make sure she has adequate documentation proving that all her expenses so far and going forward are legitimate business expenses. Without this proof, these expenses would have to be classified as drawings. On the 4th of January, Ruth makes her first sale for 1,500 to the Cozy Inn, a local business. A sale is a transaction between two parties where the buyer receives goods or services in exchange for money. The bank account would now look as follows. 1,500 will be debited to the bank account as the asset of cash has increased. An opposite credit entry would then be made to the sales account. A sale is a transfer of goods or services for money or credit. Remember, each transaction involves the receipt of a benefit, a debit entry, and a giving of a benefit, a credit entry. A sale is the giving of a benefit and therefore a credit entry. On the 5th of January, Ruth takes drawings of 500 out of the business. As you have already seen, drawings is any money taken out of the business by the owner for personal use. Once the owner takes drawings from the business no longer owes the owner that value. The bank account would now look as follows. 500 will be credited to the bank account as the asset of cash has decreased. An opposite debit entry will be made into the drawings account. Drawings are a debit entry because they are a decrease in a liability. Remember, when an owner takes drawings from the business no longer owes this value to the owner, making it a reduction in a liability. Remember, all items of expense that do not have adequate proof of business expenditure legitimacy must be classified as drawings.